So in this video, I'm going to be talking to you about what exactly is the Dan Pena's QLA model, Quantum Leap Advantage model, and why is it that it has created so much wealth that Dan Pena claims it has created, right? Why is it? What makes it so effective? Why is it that so many people who use this model make a lot of money? What is it based on? So if you are someone who has been listening to Dan Pena, you have been watching a lot of his content, and you can't quite make sense of where to start, what to do, and what is all of this quantum leap advantage stuff that is now slowly getting popular. What is this model? Because there isn't something like this on the internet. It's not very common, even though some people may be teaching it. It's not very common. A lot of the internet advice is around sales, marketing, e-commerce, even real estate, and crypto and stock and all of those things. But this seems to be something completely outside of that. So if you're someone who is not familiar with the model, who don't understand what it is, and even if you are someone who is familiar, but maybe you have some gaps, maybe you have some misconceptions, and maybe you don't even know that you have these misconceptions, this video is for you, and you would have the ability, you would have the clarity and understanding of what exactly it is and what exactly it is not. So I'm going to be clarifying. And who am I and why am I speaking on this? I've attended 2 of his castle seminars. So he conducts a seminar, it happens at his house, Guthrie Castle, and you spend a week with him with 24 other individuals. And at the time when I did it, it was about £20,000. I think it's right now about $27,000. I'm not sure exactly what the current price point is. And I've done 2 of his castle seminars. One of them is, QLA castle seminar, and the other one is QLA hardcore seminar. And so I've spent quite a bit of time around the information. I've also executed. I brought some of the most high-profile executives in UAE to be my business partners. I've negotiated several multi-million-dollar transactions, including a $3.5 million negotiation, a $10 million negotiation, and $120 and $140 million negotiations. I've presented deals in front of some of the major banks, including Citibank, HSBC Bank, and I have met the bankers. I've seen the entire process, and I know several individuals who have closed multiple transactions, and built portfolios. And I'm going to talk about all of this as well. But I'm just sharing who I am so that you have a perspective of the base of my information. I'm not speaking from what's available on Google or what's available out there on Reddit or what's just, available in, general information domain. I have been parts of some exclusive groups of individuals where this knowledge was imparted, and I was one of them to experience, receiving this information and applying this information. So I've seen it in and out. So I'm going to be sharing what exactly it is. Okay, so what exactly it is? Most of the business advice, when you go to a consultant, an advisor, a mentor, most of the advice that they give you is around starting a company, and typically when you're starting a company, the first challenge that you're going to have is product, services, and customers. You don't have any employees at the beginning in most cases. So it's going to be, what product should I choose? What service should I choose? And who are my customers, right? And then you start identifying this process. So, and then even if you have a product or service, then the next challenge is, how do I market? How do I bring my product to the market? That costs a lot of money. So it's sales and marketing is typically what your first challenge is. And most of the advice on the internet is around sales and marketing. So when somebody says, I'll teach you an online business or I'll teach you how to do e-commerce, what they're referring to is, we'll tell you how to sell things. That's what most of the offer is about. And then there's another offer, which is around real estate. Okay, you have some money and we'll teach you how to do real estate investing. We'll help you raise money from banks and we'll help you buy real estate. And then there's a whole range of other things who tell you if you have surplus cash, we'll tell you how to invest your money in public markets with public companies. And the value of the money that you have is going to grow. And then they say, all of this is nonsense. The crypto is the real thing. That's the real deal. And look at the growth. Look at the hyper growth that's happening in crypto. That's the new thing. It's going to replace all the currency, and all the currencies, the Swiss currency, the US dollar, that's all horseshit, right? It's all backed by nuclear weapons, but it's still it's horseshit. Crypto is the real deal, right? So you've got all of these systems of making money, and you analyze and you may be getting confused. I mean, what is all of this? And then this thing pops up, QLA. What is it? So here is what it is. If you are an entrepreneur, or if you want to be an entrepreneur, and if you want to create wealth, that's the only reason somebody gets into entrepreneurship, is they want to create wealth. And they know employment is not the way it's going to happen. They have to start a business. They have to start a company. They have to start a unicorn, and they have to build it. Okay, so that's established, that you're not going to get rich being an employee. You have to become an entrepreneur. There is no other pathway. You have to become an entrepreneur, right? You could become a celebrity, but not the celebrities who get into entrepreneurship are the ones who are rich. Celebrities who stay actors or musicians, they're not rich. But when they combine it with entrepreneurship, they make a whole bunch of money. So it's established that you will have to become an entrepreneur if you want to create wealth. Once you make that decision that I'm not going to stay an employee all my life, I'm going to do something big. When you make that transition mentally, then the first question that you will ask yourself is, what's the business model? Because you have so many options. You have fundamentally two business models. One is you can create a company from scratch. You could start a restaurant with a couple of friends. You could start an online business. You could start various types of businesses. You could come up with an innovative technology that can disrupt an entire industry. And if you think you can do that, I wish all the best to you. I think anything is possible, and maybe you should do that. So that's one option that you have, is starting a company from scratch, coming up with a business idea, raising funds from investors, or developing a product or sourcing a product that somebody else created and just selling it to a market and making some money off of it. So that world of entrepreneurship is coming from a standpoint of starting a company from scratch. You have to source products and services. You have to find a market you can sell it in, and you have to scale it with sales and marketing. And then you will hire employees and you will, reiterate the process. This process typically takes 10, 15, 20 years for you to hit it big. Okay. The model that Dan Pena teaches is not based on this. It's not based on sales and marketing, and it's not based on developing products and services. What the model is based on is buying businesses. You don't have to create a business from scratch. Just like you don't stitch your own shirt, I hope, you go to a market and you use the money to buy a shirt. If you want a business, you don't have to create a business from scratch. When you walk out next time, look around, and what you would see is businesses all over the place. People who have spent their whole lives creating these companies, identifying the location, developing products and services, finding the right market, establishing the right capital structure, finding out what legal entity to incorporate, done the market research, tested the products, changed the products, tested it again, found the market, changed the market, tested it again, hired employees, fired employees, and business is a process of evolution, and things keep evolving. Employees change, products change, market changes, sometimes location changes, sometimes the business doesn't work out and, they start another business, right? Somebody has gone through this process. They've spent their whole life creating a business. And the whole QLA model is about finding profitable businesses that have lasted over a decade and just buying them from owners that have gotten old, owners that almost spend their whole life creating this business and they don't have any more time. They're running out of time and they have to part ways with the business. They don't want to part ways with the business, but they have to. And I met, a 60 plus year doctor who spent 17 years trying to create a cosmetic clinic in UAE, in Dubai. And he created a successful company, but now what is he going to do with it? He's 60 years old. His son wants to go to America. He doesn't have anybody who can take over, and there isn't a very big market where he can sell that business. In fact, he didn't even know he could sell his business at one point because houses are being sold. Businesses are not bought and sold. That's what people believe. And most people are not in the business of buying or selling businesses. We like to buy houses. And we feel comfortable doing that. We buy stocks, we buy crypto, and we know how to spend money on personal things, clothing and etc. But we don't really buy businesses because we don't know how to manage them. We don't know how to run them. We don't understand them. So when we walk on the street, we look around, we see businesses, we kind of block it off unless we want to buy something for consumption purposes. But we don't ever think about the idea that, wait a second, that business over there, I could just talk to the owner and maybe he wants to sell. And maybe I could buy this business and all the money that I'm spending on this business, I could be the one collecting it. So that's the thought process. So the whole model is not around acquiring customers. So when you start a company, the business is about acquiring customers, right? Through the process of sales and marketing. This is not about sales and marketing. This is about buying entire businesses which already have products and services, which already have an established customer base, which already has all the trained employees that are now used to the work, and it has an aging owner. That's what we're looking for. And 17 years of time has been put into it. The only reason you don't make a shirt when you need a shirt is because somebody else put in the work and you just have to write a check and you can get the shirt. So what you save is time. So the entire play of buying a business is about saving time. And time is one of the most valuable resources, is because you can make money back, but you can't make time back. So the whole game is about buying a business, not creating one from scratch. Because when you create a business, you're acquiring one customer at a time. When you buy a business, you may be acquiring 10,000 customers, 20,000 customers, 100,000 customers at a time, one transaction. Because the customers have a relationship with that business, it already has an established customer base. You don't have to create your own customer base. You're acquiring an entire customer base. So creating a business takes 15 to 20 years. Buying a business, assuming you have funding in place, you could do it in 6 to 8 months. Okay. There are other processes involved which adds a couple of months more, but that's right about the time frame is what it takes to buy a business. You can do the time comparison. Now you might say, how do I buy a business? I don't have any money, And the answer is you don't need the money because you can get the money. The money is there in the market. You don't have to have money in your pocket. You can go and raise the money. Just like you raise the money to start a company from a venture capital or investor, the banks finance deals that can cover the debt service. So you could find a business that's profitable, that's cash flowing, If this business, without you, went to the bank asking for a loan, the bank would look at its financial statement and be like, this business has been profitable since last 5 years, 10 years. And we can see the financial statements and we see that it's profitable and it has a good credit score, and we loan the business the money because it's got cash flows. You remember when you can get, the bankers call you for credit card? Well, the reason they call you for a credit card is because you have been generating all of this salary or cash flow every month, and you've got good ratios, and the bank is observing your cash flows and your ability to generate money, and based on that, they calculate how much loan they can give you, and then they give you the loan, right? The same thing happens with the business. The business has got financial statements which reflect how much money it's making, which gives the bank the ability to calculate what the cash flow, how the cash flow ratios are, and how much debt it can give the business, how much money they can loan. And the banks can feel certain because this business has been producing profit since last 5 to 10 years, right? So the bank will loan the money mainly because there's cash flows being generated. And banks make money by lending money. The only way the bank can make money is if it lends money out. The bank, there is no other way the bank can make the money except for processing transactions. We know that. But the main source of bank's income is when it lends out money and makes interest, because cash in the bank gets rotten and goes down in value. So they have to push money out. So they have too much money, too much liquidity, and they want to push money out. And what they're looking for is sources of cash flows to pay the interest and the principal. And one of the sources they look at is your personal financial statement. That's why they have a product called a credit card. But when they're looking to give out big loans, they're looking for cash flow sources. And when you find a business that is producing a lot of money, profit every year, you could negotiate a deal and you could go to a bank and you can finance it. The reason bank gives you the loan is because the business you have identified pays off the loan. Now, there is a big misconception here with the debt portion. The debt is not in your books. So me, Prithvi Chauhan, is not going to be having debt in my personal books. Okay? There is my books. There is the business that I'm buying, their books. The company that I form, that also has books. And I can form a second company that will also have books. All of these are separate. And if I have other business partners, their personal financial statements is all separate. And everybody has a different credit score. So you are different. The business you're buying is different. The company you form is all different. So it's important to have a distinction legally. All of these are different. Now, it's different in different regions. You may have to consult a lawyer and they'll help you structure this. But understand, legally, me as an individual and the company that I form are two separate entities. So debt could be in my personal books or the company that I formed, its personal books. So I understood this concept pretty late. And one of my lawyers, he explained it to me that, who's borrowing the money, Prithvi? Is it you or is it the company? And I was like, where is the advantage? He said, the advantage is when the company borrows, not you. And I was like, this is interesting, that I'm separate and the company is separate. This is a little bit crazy because I can form infinite numbers of companies, I think. So the debt, when you go to the bank looking for money, the bank is not interested in your financial statements. The bank doesn't care because the bank is not loaning you the money. The bank is loaning the company that you're acquiring. The bank is loaning them the money, right? It's very similar to a real estate transaction where, the bank is giving you the loan based off of the real estate that you're buying. It's not necessary. Now, if it's a personal real estate, then yes, the bank will look at your financial statements. But let's say you're buying a building. The bank is going to be interested in the building, not you. personally. The bank is going to be interested in how much cash flow the building is generating, not you personally. So just like that, when you go find a business and you take it to the bank is going to ask you questions not about you, but they're going to ask you questions about the business. They are financing the business. So it's an important principle to keep in mind. You're not the borrower. Unless the bank asks you for a personal guarantee, then you are personally also involved in the deal. Otherwise, it's the company you formed and the business you're buying. These two entities are involved. And I can go into legal complexities of that. I've made videos on that. You can go see it. But the main point is that the business producing money is going to pay off the loan, not you personally. So that's what the whole business model is about. You leverage debt and you buy companies. And you can keep doing this over and over again. And you can create an entire portfolio of companies and you can combine them together into one group. So, for example, if we take a scenario of a restaurant, instead of acquiring one restaurant and being a restaurant owner and creating a restaurant, you acquired several restaurants and you created a chain of restaurants. A restaurant is not a good industry. So this is an example because you may be familiar with restaurants. But restaurant is not a good industry to buy businesses in. And I'm just giving an example, is that you find a company, standalone, it doesn't have a lot of value, so you can buy it at a discounted price. But when you combine 20, 30 of them together into a group, the value goes up. Why? Because a buyer, when they want to buy companies, there are several people who are into buying companies like private equity firms or funds. There are various kinds of funds who are interested in buying companies. They have to do one deal with you and they will buy 30 companies at a time. If they had to do this process on their own, they have to run 30 different deals. And that's a lot of time. So the owner put in the time to create the business. You put in the time to combine the business and they will pay you a premium for the time that you put. So it's a very simple arbitrage where you buy several smaller companies, you created a big company. The big company has a lot more value than a smaller company and you sold it for a much higher price than what you bought it. And that's the whole game. If you had to individually create these companies, it would take you probably a century to do it. People who have created companies from scratch like this took a long, long time to do it because there are so many variables involved. If you have to put in every single piece from scratch, it's going to take a long, long time. So what you do is you leverage off of people that existed before you, that were born before you and that have been at this for a long time and they want to retire. You help them retire, you acquire their business, you acquire several of these businesses and then you sell them at a higher price. So you are now putting your time as well. And the private equity or a bigger group that comes to buy you out is going to leverage off the work that you put. And every time the company is sold, assuming it's profitable, the price will become bigger and bigger because each person who held these assets worked to develop them more and more, and the asset keeps getting bigger and bigger. So that's, in general, the principle of buying businesses. Now, you might say, I have no idea about how to do this. I don't have any education. I didn't go to Harvard. I didn't go to Oxford. Maybe those guys have the ability and capabilities to do it. Well, let me tell you a couple of things. You need a finance education, accounting education, and experience. It's not just enough to have education. You need to have experience in finance, accounting, legal, whatever industry you go in, you buy companies, operational experience in that company, and various other expertise and experiences. If you have to, once again, do all of these from scratch, it's going to take you decades and decades. It's going to take you centuries to get experience in all of this if you had to do it by yourself. So it's not about what you have, it's about what you can get. It's about what the market has. The market has a lawyer. Why would you study law when you can just get a lawyer on your team? Why would you study about operations when you can get a guy who has spent 30 years of experience doing just that, operations? Why would you go and clear accounting exams and get a license when you can find somebody who has the license? Why would you go and find somebody, learn about and find out about finance when you could just get a guy who has invested 30 years in finance and you ask him in simple terms, what does this document mean? Or how do we structure this deal? And they'll tell you, this is how you do it. Based on my 30 years of experience and billions of dollars in deal experience, I think this is the best way to do it. They'll tell you, if you were to go and get all of this experience, it's going to take you decades to do it. So it's the whole model is about leveraging what's already there in the market. It's not about and then using those to build on top of what's already there. We don't have to reinvent the wheel. We don't have to discover the concepts of gravity or Newton's first law or Newton's third law. We don't have to do those things from scratch. Those things have been figured out. Those things have already been developed. We don't have to, invent technologies that already exist. We can just leverage the technologies that exist and build on top of that. And that's the whole principle. If you just walk outside the door and you look around, there's one thing that you would see that's guaranteed, and that's businesses. You would see businesses around you. So if there are businesses already around you, created, cash flowing, why wouldn't you go and buy them? Why would you think about creating something that already exists? You think about a business idea, most likely, not in all cases, but most likely it already exists. You have an idea of a coffee shop like that you want to create, it already exists. Somebody's done it. Clothing store, somebody's done it. A medical, whatever, somebody's done it. You could just find those and buy those. How do you do it? With debt. Why would the bank loan you the money? Because you're buying a profitable company at a lower price and you're stretching the payments and you're making sure cash flow covers the debt service. I cannot go into too much detail into this video. This is just to give you a summary, an overview of the picture. How do you get the experience and expertise? You bring people who have experience and expertise. So you're leveraging people who have experience and expertise. You're finding businesses to buy. How do you get the money? You find a business, you structure a deal, you go to a bank, you borrow it, you finance it. And that's the model. And you keep building this portfolio, keep combining businesses together, because right now they're operating separately. And when you combine them together, they can operate interdependent, in an interdependent format where they depend on each other or for various functions. How do you manage all of that? Well, the owner, you're going to lock him in the deal, and this guy created the business. If a restaurant owner started a restaurant and has been running it for 15 years, listen to the restaurant owner on how to run his business, and get the guy who's on your operations team to listen to the whole conversation. Record it if you want. Take his permission to record it, and he'll tell you how to run the business that he created. And your operations guy who has 30 years of experience will understand what he's saying. If you don't understand everything, he's going to translate, what he means. And he'll tell you what employee has what attitude and which employee, is good, which isn't that good, and which is the most important, which is not important. He's going to tell you the internal workings of the business. So that's how the model is structured. And you buy several companies together, and it's much faster than creating a company from scratch. So here is how, just giving you a financial scenario, here is how a growth in happens when you start a company. Okay. Maybe $0 to $1 million, it's a hyper growth. But let's say you're at a $1 million range. It typically grows 5 to 10% every year. So this is called organic growth. When you're growing through marketing and sales, that's the only way to grow when you have a company. So when you start a company, so it's $1 million. Next year it makes 1.1. Then it makes 1.2. Then it makes 1.3 every year. Then maybe it makes 1.7. That's how the growth happens in most of the companies. This is how growth happens in an acquisition scenario. You acquired a company which has a revenue of $1 million. So your revenue is $1 million in year one. Then you acquired two more companies, $2 million each. Now you've got a revenue of $5 million. Then you acquired a $5 million revenue company. Your revenue is $10 million. You're on year 2 or year 3. Then you acquired a $10 million company, and so on. And every time you acquire a company, the company that you acquired, that company's revenue keeps getting added to your revenue, because you're not acquiring one client, two clients at a time. You're acquiring 80,000 clients, 10,000 clients, 20,000 clients. My mentor, Dan Pena, says you are not fishing with strings, you're fishing with nets, because you're acquiring a bunch of clients at the same time. And that's the whole game of mergers and acquisitions. This whole model is based on mergers and acquisitions, buying companies. And it's a much faster way to create wealth than if you were to start a company from scratch. It's very risky. It's something that you're creating out of a concept, and it may not turn out the way you want it to. But when you buy something, you can see it with your own eyes, what you're buying. It's kind of like creating a shirt versus buying a shirt. When you're buying a shirt, you can try it on, and see how it fits. When you're creating a shirt, you may just create it and then it may not fit the best in a way that you want, and then you got to keep adjusting it. So that's a difference in principle that the model follows. So I hope you enjoyed the video, and if you did, hit that subscribe button, and I will talk to you soon.